Welcome. This is Stacy Francis here for our 2015 investment forecast and third quarter review. I'm calling in from Francis Financial, and I'm the president and CEO. Francis Financial is simple and elegant wealth management. At Francis Financial, our award-winning teams guide individuals and families with over 1 million in investable assets through life transitions. We work with women going through divorce, after divorce, women who might have lost their spouse, unfortunately, or couples that are going through transitions, such as starting a new business or having a large job change. Today, we're going to focus a little bit about what has happened so far in the stock market this year, as well as what we expect in the years to come. We all know that it's been a very volatile time, and if anything, might have caused you some fear and worry. Well, what we have to tell you today is not to worry, but more importantly, to make sure that your portfolio is truly invested for not only what is going to work for you for today, but what's going to work for you for the long run. The volatility that we see today, trust me, it is not going away. Our agenda today is we're going to go over our market review, and then we're also going to look at our investment outlook as well as our portfolio positioning to take advantage of the opportunities that we have in front of us. This last quarter was pretty phenomenal with a lot of moving parts. There has been increasing concern, particularly about China and a potential slowdown that we're seeing. We had a big surprise, particularly a devaluation of their currency, helping to really trigger a drop in global equity markets around the world. Unfortunately, emerging markets really truly fared the worst because of this, which is, to be honest, not surprising. This negative environment, particularly for global stocks, had a great impact on emerging markets. Core bonds, also known as investment grade or treasury bonds, held up better than equity markets. They benefited from investors seeking safety, while more credit-sensitive sectors such as high-yield bonds and floating rate bonds had a little bit of a harder time. The Federal Reserve held off on increasing the federal funds rate at this last September meeting, stating that recent global and economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. For additional explanation, in our press conference, Fed Chairman Janet Yellen pointed out specifically that recent developments in China, as well as emerging markets, were key factors that have given them pause, given them concern. She really focused on the fact that due to tightening financial conditions with the stock market decline, strong dollar, and wider credit spreads were all significant issues that went into their decision to not raise interest rates. So how did the market do? Well, you can see in our chart here, we've put information both for the third quarter alone, that is from July 1st through the end of September 30th, as well as year to date, starting from January 1st, 2015, all the way until the end of the third quarter, September 30th, 2015. As you look at here, we see U.S. Treasuries had very minimal gains for the year, only up 1.8%. U.S. investment grade bonds, barely positive, not even 1% for the year. Municipal bonds had a slightly better showing of 1.77%. Floating rates for the quarter were down, but were up for the year slightly. And here we go into our negative territory. We see both on a third quarter as well as a year-to-date basis that high-yield bonds, large-cap stocks, small company stocks, as well as developed international and emerging market stocks all were negative, both for the third quarter as well as for year-to-date. So overall, a pretty tough year so far. So how should you be invested, and what's going on? What's causing all of this volatility. You can see here on our next chart, the world stock market performance just over this last quarter has had a huge amount of news driving what's going on in the equity market. In particular, we see some very unique events, particularly an announcement with the Eurozone economic slowing growth. That was an announcement, and you can see that the global market fell quite precipitously right after. Then we also see Janet Yellen not expecting to raise rates in September, saying that they would not raise rates, but that throughout the year, by the end of 2015, expecting to have rates raised. And then finally, we see the global markets logging their worst quarter in stock market performance all the way back since 2011. Essentially, what this chart is showing is that global economic news is truly one of the big drivers of the volatility that we see today. Why is that? Well, it's because of investor behavior. And investor behavior can be explained by what I call the most reliable chart today. We all know that emotions play a very important role when it comes to investing. When an investor panics, you can forget about the stats, the studies, the history that tell us we never want to sell low and buy high. All logic goes out the window. But unfortunately, the point at which people can no longer take the pain most often occurs at the tail end of a market downturn, right about here in this chart, right before we start to see an upturn of increasing market highs and growth. When this happens, it takes people a long time to trust the market, a long time to get back into the market, and they typically miss out on the sharp rebound that always occurs right after a market drop. This chart we put together was to help you visualize the feelings that many investors feel. And I'll tell you, I am one of those investors. In fact, my portfolio is a little bit more aggressive than many of our clients. Why? Because I want to experience what our clients feel. And I, too, have to admit, as wonderful as a financial planner you may think I am, I still have emotions when it comes to investing. And here are some of those emotions. The emotion of optimism, excitement, thrill, euphoria when you're getting unbelievable high returns. Remember the bubble of the late 1990s? Remember the bubble of 2007 into early 2008? But then when we see losses, anxiety, denial, even stronger fears, such as depression, panic, capitulation, despondence, and at the bottom, such fear, such pain that some investors can't take it anymore, and they get out of the market. And as we see this wonderful, wonderful rebound, they miss out. The most important key for individuals is to stay with your portfolio and make changes, not when there's a huge amount of volatility, but you're making changes because your risk has changed for the long term. You're deciding to retire, so maybe you need to be more conservative. You're adding additional money to it from an inheritance, so maybe you feel like you can take on more risk. But do not change your portfolio because of what is going on in the market. That is not the time to change your risk tolerance. I want you also to understand that it doesn't mean that you don't make tweaks. If there are unique opportunities, like some of the ones I'm going to go through today, you need to make a move to take advantage of those opportunities. So let's talk about what are those opportunities and what are some of the data points that we're looking at to really see how we should be positioning our portfolios. Here you see that the Federal Reserve decided not to raise the federal funds rate. Well, one of the reasons that they decided not to raise rates was specifically because financial conditions have been tightening over the last few months, but are still relatively loose. Let's take a look and see what is happening, particularly with inflation. The Federal Reserve and Janet Yellen very much are concerned about inflation. Inflation is the cost of your Poland Springs bottle of water. Today, that bottle of water might cost you $1. And next year, it could cost you $1.05. At this point, roughly we would say that inflation has been, 5%. Inflation is normal. Inflation is healthy. You want to have inflation. If you don't have inflation, then you as a consumer may want to wait till next year to buy that new refrigerator or that new car because you believe that there's going to be no inflation or essentially deflation, meaning that you can buy it in 1 year for less money than it might cost you now. Obviously, some big issues for the economy if that were to happen. So inflation is very important. And where we are right now, you can see that we're hovering at about 1.3%. And this is far below what we see as a healthy rate, a preferred level of roughly 2% inflation. So this is one of the things that we are looking at, as well as the Federal Reserve. And this is something that also is one of the issues that Janet Yellen referred to of why they are not yet increasing interest rates. So let's take a look at commodities. So everybody has been enjoying the fact that when you go to the gas pump, that the cost per gallon is lower than we've seen for a long time. And essentially the stronger dollar that we have and concerns about global growth have really contributed to the sharp decline that we've seen here in commodities such as gas. In fact, we have not seen these trading levels all the way back since 1999. Declines in commodity prices, as well as the weakness that we're seeing in emerging markets, have definitely dominated the markets and has dominated CNBC too. How does this impact our economy? Well, it feels good for the consumer in particular when you have to pay less for your oil, your gas, your electricity. However, it's not so good for these companies. In fact, we just saw one of the largest utility companies announcing massive layoffs, and part of the reason they are saying is commodity prices. So this is, again, an area of both strength but also weakness in the economy. So are we going to have a recession? That is the magic question. And in my fortune teller ball of Wall Street, unfortunately, even professional forecasters are notoriously bad at calling when recessions are going to happen. Here you can see in this chart, going all the way back to 1970, actual GDP growth. This is the gross domestic product of the U.S. This is what we call growth of the economy. And here we see the forecast in this lighter shade. When we see a recession, it's followed or is preceded by a drop in growth of the economy. And what's interesting, during times of recession, look at this, very low GDP resulting in 2008 into 2009, the actual GDP growth was expected to be much higher. So what do you take away from this? It just means that whenever the next recession comes, those professional forecasters, as well as most investors, will not have predicted it. So what does that mean? Do you throw your hands up in the air and say, well, then forget it? No. It means that you need to have a very well-balanced portfolio that can produce results in both good times and bad. So let's talk about large company stocks. How are large company stocks expected to perform over the next several years? Well, one of the factors that we look at is we look at profit margins. Profit margin is essentially the profit of the company, the revenue of the company over the cost. For every dollar that they make, how much did it cost them to make it? So with the higher the profit margin, the healthier the company. And historically, very high profit margins have been followed by sharp declines in company profitability. So the normal mean profit margin is roughly 5.8%. This is the historical average. And where we are at, we are trading much higher than that. You can see that we're at sky high nose bleeding area of 8.5%. Over time, as you can see here, both in higher profit margins and lower profit margins, they tend to revert to the mean. And this time, we don't think there's going to be anything different than that. We do believe that margins are going to trend lower over these next 5 years, which implies lower earnings for large company stocks going over. That means that our expected return for U.S. stocks over the next couple years is lower than what we've seen over the last 5 years. So in fact, let's take a look at this. Let's take a look at the European stock market compared to the U.S. stock market, as well as the overall global stock market. So as you look at this chart, let me dissect this for you so it's easier for you to read. This beautiful royal blue line is demonstrating the multiples for European stocks, for their price to earnings multiple. Then we also have U.S. stocks, and this is this gray dotted line here. And then finally, we have global, which includes both U.S. as well as international, as well as emerging markets. So where are we? Where are we? Here we can see that U.S. stocks are trading at higher price to earnings multiples, much higher than European stocks. What does this mean? Well, based on current earnings, it's showing that European stocks are fairly valued and actually are cheap. They're cheap compared to U.S. stocks. We also believe that European stock market valuation multiples will at least be in line with their long-term norm, which is consistent with economic and earning recovery. Because of this, as far as looking forward and what we expect from European stocks to produce for growth is anywhere from a 10 to 11% annualized return, even for our more moderate recovery scenario. Essentially, we're saying that we expect going forward that European stocks will perform better than U.S. stocks over the next 5-year horizon. So what about emerging markets? Emerging market macroeconomic fundamentals are actually better today, despite all the news and all the crisis and all the scary things you hear on the news. They are better today than they were during those crisis-prone years, if you remember, in the late 1990s and early 2000s. Here we have a chart showing the main participants that are considered part of that emerging market community, showing their current account balance, which is one of the factors that we look at for a healthy, financial, stable economy. And here you can see very high current account balance percentages. We have Vietnam, Thailand, Korea, Malaysia, Philippines, Hungary, Czech Republic, Slovenia, Hong Kong, Chile, Peru, Argentina, Poland, Russia, Ireland, India. And then we have a few that have deteriorated, again, since the Asian financial crisis. These are all things that we believe talk about as an important factor of that why, despite the recent declines in prices that we've seen, we believe emerging market stocks have become sufficiently attractive to put even more investment into them. And let me show you something. I know that this is contrary to what you would expect. When you see a part of your portfolio going down in value, as we've seen in emerging market stocks, it can be very difficult to use that as an opportunity to invest in that portfolio, in that area of the market, even more so. But let me explain to you why this is so important. Developed economies, which you can see here in blue. Developed economies are growing more slowly than developing economies, such as emerging markets. And you can see going all the way back to 2005, developed economy, such as like the United States, growth rate versus developing or emerging markets. Blue versus orange. In fact, some years, blue was negative. But in every single scenario, every single year from 2005 all the way through our estimates going out to 2020, we see that that orange does better than blue. Orange, those developing economies, those emerging markets, versus developed economies such as Canada, UK, the US. It makes sense. It makes sense. Emerging market economies are growing faster, much faster than the developed world. And so how do we expect them to grow? What are our actual return expectations for the different models that we review? Our estimated asset class returns across all of our scenarios show that emerging markets fare well in nearly all of them. The base case is what we consider our most likely scenario. It's what we believe we are experiencing right now. And this shows you what our estimated average annual returns will be over the next 5 years. And for U.S. equities, we expect a 5% return. Developed international, Europe, a 14% return. Emerging markets, an unusually wide return expectation, anywhere from a low of 12% to a high of 19%. This is 100% very much dependent on whether there is a hard or a soft landing for China. REITs, or real estate investment trusts, 5.8%. And bonds, nothing to get too excited about, except for high-yield bonds bringing in a little over 6%, and floating rate bonds bringing in a little over 6% as well. If we have that bull case scenario, we're breaking out the champagne. And you can see that from that paltry 5% rate of return each year over the next 5 years for large company stocks, we're looking at potentially a 12% return. Higher still, 21% for developed international, 26% for emerging markets. And even in bonds, we're still looking at some nice returns, particularly from high yields as well as from floating rates. This is important. And as far as the big trends that we're seeing here is that our outperformers, no matter what the market conditions are over the next couple years, are emerging markets as well as developed international, such as Canada, the UK, Germany. This is what we look at. So the next 10 years are not necessarily going to be like the last 10 years. The next 30 years may not be the same as the last 30 years. Let's take a look. Historically, from September 2000 September 1985 through September 2015, we have experienced a 10.71% return for the S&P 500, which is a conglomeration of large company stocks. Going forward, do you remember that return? We expect the next 5-year projected annualized return to only be 5%. For investment grade bonds, the returns that we saw for the last 30 years was on average 7.04%. Going forward, our 5-year projected annualized return for investment grade bonds is a paltry 1.4%. So what do you do? What do you do? Well, you take a look at historically what types of returns different portfolios have had. So you can feel comfortable that you can stay with your portfolio both in good times as well as in bad times. We have a lot of information up here, and we're going to look at 2 charts in particular. And essentially, what these portfolios do here is illustrate the performance of different stock and bond mixes, highlighting the benefit of diversification, the benefit of not putting all your eggs in one basket. Essentially, allocations with more stocks are considered riskier, but also from this chart you're going to see have higher returns typically over time. So take a look. Let's go. Let's do 100% stocks, something that I would never say to anyone to do. But look at the long term. We have 5.14% return each year over the last 10 years. 100% stocks, if you had invested in that grouping, you would have had a return of 7.39%. And the last 3 years, 7.52% each year. Now, what about if we had invested differently? 100% in very conservative treasury bills. You can see that our returns over the last 10 years would be essentially flat. I think we can all agree that the right portfolio for you is most likely not 100% stocks, and most likely it's not 100% treasury bills. It's more likely somewhere in between. So what would have happened in these different portfolios had you invested them with $10,000? So what we did in this chart, we took all 5 of these portfolios and invested $10,000 in them, starting all the way back in 1988. Starting in 1988, we would have seen that 100% stock portfolio grow very nicely. And you can see it's grown upwards past $70,000 from that original $10,000. Your treasuries, you actually would have just kept the same value. For the 70% stock and 25% bond allocation, not so bad. At about $40,000, a 50-50 allocation, 50% stocks, 50% bonds, you still would be celebrating. You'd be celebrating a little over $20,000. And that 25% bonds and 25% stocks and 75% bonds, you would have been looking at a return of a little over $15,000. We added this chart for you to see that sometimes it's very easy to look at a period return and feel comfortable with what that means. I'm fine with a 3% return. I'm fine with a 2% return. But it's really important to see long term, what does that mean for each one of your dollars? And it's part of the reason why diversification is so important. That in good times and in bad, diversification over time is going to protect you. And you can also see the path of the person who invested 100% of their money in stocks. It looks like the cyclone out at Coney Island. Oh my gosh. Whereas the other portfolios have much less rise and dip for you to have to go through. I know that we went through a lot of information today, but I hope that I was able to take what can be considered extremely complex information through charts and graphs of what's going on in the economy, and that we've been able to take it into smaller, bite-sized pieces, so that when you look at your portfolio and you see those ups and the downs, before you get scared, you take a step more, and you see how you're invested. Are you seeing those significant ups and downs because you have too much stock in your portfolio for the long run? Or are you not seeing returns that you would like to see as far as higher long-term returns because you're invested too much in low-returning bonds? It's a mix. And creating a portfolio is an art. And a portfolio for you is not necessarily the right portfolio for your best friend. But the most important thing I have to say is that the times to change your portfolio, to change your risk tolerance significantly from more aggressive to more conservative, is not when the stock market is falling. You got to take the emotion out of it. You have to think about it as a business owner might. And think about, is this the right portfolio for you when things are a little more even? With that, I would like to say a great big thank you for tuning in for our third quarter outlook and portfolio positioning call. If you have any questions or know of anyone who would like a second opinion about their finances, please reach out to us. We offer a second opinion for our friends and colleagues and acquaintances, for the people you love. The Wall Street Journal put out a fantastic article that ran based on a poll that they conducted. They asked individual investors who would appreciate a second opinion on their portfolio. And a full 80% of investors said that a second opinion from another financial planner would be valuable to them. So let us know. And if we can give either you a second opinion or a friend, a family member, someone you care about, please let us know. That is what we are here for. Again, this is Stacy Francis from Francis Financial. Plan, grow, protect.